Well, RBI has increased the risk weight asset requirement for lenders yesterday. Let's take a look at these new rules, analyst view on the same and what bankers have said earlier. So for banks in consumer credit, all loans except housing loans, education loans, vehicle loans and jewelry loans would attract 125% risk weight assets, that is RWA, from 100% earlier. Credit cards for banks will attract RWA of about 150%, up from 125% that was there earlier. Loans to NBFCs, that is non-banking financial companies, that will attract 125% RWA, up from 100% earlier. Now, banks with high unsecured book is RBL Bank, IDFC First Bank and ICICI Bank. Banks with low unsecured book is PNB, Equitas Small Finance Bank and Kotak Mahindra Bank. For NBFCs, RBI has mentioned that unsecured loans excluding microfinance institutions and the same of loans that I have mentioned for the banks will have an RWA increase to about 125% from 100% earlier. Credit cards for NBFCs will attract RWA of 125%, up from 100% earlier. Loans from banks will come in at a higher interest rate for NBFCs as well. So NBFCs with high unsecured book is SBI card, 100% credit card over there, Aditya Birla Capital and Sundaram Finance. NBFCs with low unsecured book is IIFL Finance, L&T Finance, etc. So RBI had in September 2019 reduced the risk weight requirement on unsecured retail lending or consumer loans. So personal loans back then had its risk weight assets or RWA reduced to 100% from 125% earlier. This was done to help in reducing the cost of such loans to lenders. The impact on capital adequacy ratio in terms of analyst estimate for SBI card, CLSA estimates a 415 basis point decline, Axis Capital estimates a 416 basis point decline and BofA Securities estimates a 466 basis point decline. For Bajaj Finance, Citi expects more than 190 basis point decline in capital adequacy ratio, CLSA estimates a 230 basis point decline and Axis Capital estimates a 240 basis point decline. Amongst NBFCs, for Piramal Enterprise, Citi estimates more than 100 basis point decline in capital adequacy ratio. For L&T Finance, Citi estimates a 55 basis point decline. For Shriram Finance and Cholamandalam Finance, Citi estimates anywhere between 20 to 30 basis point decline in the capital adequacy ratio. Amongst banks, HDFC Bank, Axis Bank, Bank of Baroda, Federal Bank, over here, Citi estimates a 40 to 50 basis point decline in the capital adequacy ratio. For SBI, PNB, AU Small Finance Bank, Citi estimates a 30 basis point decline in the capital adequacy ratio. RBL Bank, ICICI Bank, Kotak Bank and IndusInd Bank, Citi estimates less than 25 basis point decline in the capital adequacy ratio. Amongst fintech, CLSA suggests observing the impact on the growth of fintech intermediaries like Paytm with the expectation that it won't be a large impact on them. We have some of the statements coming in from bankers. ICICI Bank had mentioned in their con call after the Q2 FY24 result that for personal loans, they will continue to monitor the portfolio and take loans that actually meet their credit filters in customer segments they are comfortable with. Axis Bank in an interview to CNBC-TV18 had stated that the RBI has cautioned about personal loans and they are not taking additional risk, but closely watching the portfolio. These changes and estimates suggest a potential impact on the financial position of banks, NBFCs and fintech companies, influencing their capital adequacy ratio as well as risk profiles. It reflects the regulatory effort to manage the risk in the financial sector.